All right, Martin, welcome to Cassandra.
Thank you very much for having me.
Martin, for all of the, or for the few people that do not know you yet, do you want to quickly introduce yourself?
That's generous. I'm a finance professor, a finance and economics professor at the University of Oxford. I'm also currently the area head for the finance, accounting, management, and economics area there. I run the blockchain program, a program on artificial intelligence in banking, and what else? That's mainly it, I would think. I mostly do research on asset management and the consequences for society.
Right, and before we started recording, we just quickly chatted about, okay, so index investing might have some, interesting consequences for society, maybe good, maybe bad. Do you want to take us back a little bit, give us some background, like when this index investing trend that has been going on for many years, many people are talking about like the repercussions of it, or already. Like, where did it kind of really start to interest you? Kind of take us a little bit back on this.
Okay, well, that's a great segue to the past indeed. So my PhD is from Princeton, and at Princeton back in the day, many years ago, many decades ago, was a guy called Jack Bogle. He, in his later career, was the guy who started Vanguard, which is now the largest provider of index funds by some measure. There's also a guy called Burton Malkiel who wrote an influential book called A Random Walk Down Wall Street. The point of kind of like both of them is that it wouldn't be reasonable to think for the average person on the streets that they could outperform the stock market, or even that they could find an active mutual fund manager that would outperform the stock market. And the reason is pretty simple, that if you are fantastically convinced that Tesla is undervalued and you should absolutely buy it, then you're buying that from someone. And that someone apparently thinks that you're wrong. Okay, so most trade you can really only rationalize by people disagreeing about whether the stock is over or undervalued. And guess what? One of them is right and the other one is wrong. And it takes a certain amount of conviction of your own abilities to think that you would be the guy who's right and the other person is wrong. And obviously the other person thinks the same thing about you. So, a little bit zooming out of that makes you realize that this whole thing is not just a zero-sum game, as you would think. It's actually a negative-sum game because you pay commissions in order to trade, right? So who actually benefits from that is the market maker, and they make a killing. Anyway, so these two guys came up with the point to say, like, look, why don't we just create a product that doesn't even pretend to want to outperform the market, but just to mimic it, and that at a very low fee. And they have saved investors just billions and billions of dollars in money management fees. And if there's any takeaway individuals should, the listeners here should take away from that, is that you should probably consider buying index funds rather than trading individual stocks or cryptocurrencies or whatever, because you're probably losing money doing that, even though you don't.
I would add the caveat here that this very much depends on your investment caveat, because it's on your investment mandate. Like, like if you have an investment mandate where you say, okay, we want to take a certain amount of risk. I don't want to be like the full-on defender here of the buy side, but I would say there are reasons for, not only outperformance, but you take a particular amount of risk. That's why these comparisons often, do not make sense. Like, comparing hedge funds to indexes and so on and so forth. But yes, okay.
So that's fair. Let's just, for the intellectual entertainment of all people involved, take that one level further. You can buy an index fund that's double leveraged, or an exchange traded note that promises you twice the daily return of the S&P 500. So if you want to lever the portfolio, even you can buy that via an index, or more precisely put, an exchange traded product. So again, like, this doesn't actually really challenge your conceptual point that there can be reasons to deviate, and we can get to a few of those in a moment. Just like first order, you should have second thoughts about trading individual equities. Anyways, so there were these people, and they hung out at Princeton at our lunch seminars and whatnot. So I actually know Jack Bogle from back then, and was interested in that. And I also had a classmate who thought about the theory of that, what the societal effects might be, or in particular the effects on competition, if we finance professors were successful enough at telling individual MBA students and podcast listeners that they should all buy index products. And this is basically what my research these days is about, to think about what happens if we're really successful with that message and index products become just gigantically large, so that Vanguard or BlackRock or the big index fund providers become the largest shareholders of a whole bunch of firms. So that's and how that changes the governance of these firms and the way they compete and what it all means for capitalism. So that's one topic. The other topic is, what happens if we're successful and all these households now hold less risky and better performing portfolios, and presumably they're going to put more money into the stock market, which is the whole point. That's the goal of the exercise. But if they do that and demand for stocks goes up, then you would think that the price of stocks also goes up. But if the price of the stocks goes up and the profits stay the same, that means the returns go down. Right. All right, I'll say that again, because that actually takes a moment of thinking. Right, so the company makes 100 euros or dollars or whatnot of profits every year, and you get to buy it for 1,000. That means you make a 10% return every year. But if you have to pay 2,000 for it, then the return is only 5% anymore, right? So the more people buy the equity, the more the demand for equity goes up, the lower the expected returns going forward. So in a very funny and quirky way, that's actually kind of bad for investors when you think about it, right? So I benefit from buying the index funds. I just advertise that. But I'm hurting you. I'm hurting your expected returns going forward by driving up the price of equity by buying all these indexes. And it just so turns out that in equilibrium, so once I take into account the price impact of all this demand for equities, it might just be that index funds are actually bad for investors, although it's good for every individual one of them. So that's the second quirky point. The third quirky point is, so ETFs have a tax advantage over mutual funds. And presumably that's one of the reasons for the popularity. It's definitely one of the reasons for why I recommend them to individual investors. But, you know, from a perspective of society, having really cheap ways of avoiding taxes is not so clear to be welfare enhancing, let's say. And also we have thousands and thousands of index funds and ETFs these days, which enables you to do a sophisticated form of tax loss harvesting, in case that's a thing that you're familiar with. You know, the notion that when one of your stocks goes down or one of your ETFs goes down, well, you sell it and replace it with one that has very similar characteristics, but not similar in a legal sense, that the tax authorities wouldn't allow you to do that. So that's yet another way how you can save taxes, which is obviously good for the individual, but not obviously good for society. So those are three reasons why indexing may be good for individuals, but it's not obviously good for society.
And Martin, before we go further, right? Like, can you give us a little bit, like, you know, a little bit detail on the scale? Because I think, like, you know, many people are not aware how massive index investing has become, what share of the market it actually is now, and how large the big players are.
All right, so that's a good question. That's an excellent question. How do we start scaling that? So the largest sovereign wealth fund in the world is Norway's oil fund.
Right.
Norway's oil fund has about $1,000 billion assets under management. And people think of that as large. BlackRock has close to 10 trillion, so 10,000 billion assets under management. That's about 10 times as large. Vanguard is around 8 trillion, so 8,000 billion. All right, what does it compare to? Say the US stock market cap, so all publicly traded stocks in the US, depending on when you look, let's call it 35 trillion or so, okay? So BlackRock's assets under management are about a third of US stock market cap. Now that's kind of like super misleading, because BlackRock's assets under management are not just equities, and they're definitely not just US equities. Mm-hmm. They also include a whole bunch of bonds. But again, the point here is just in terms of, giving you a sense of the scale. Another way of giving you a sense of the scale is that to compute which fraction of the average publicly traded firm are controlled by the Vanguards and BlackRocks of this world. And there, so the research I've done with a colleague in Oxford and a student of mine at Oxford as well shows the latest one on that. And the answer is that Vanguard controls just above 10% of the average S&P 500 firm stock. Okay, so you take the average S&P 500 firm, single class firm, and they control just above 10% of that. BlackRock a tiny bit less, State Street a tiny bit less, but these three large asset managers combined control about 23% of the votes of the average S&P 500 firm, right? And it's kind of hard to not be influential when you control 23% of the stocks. So that's another way of giving you a sense of the scale of the asset managers.
So then let's talk a little bit about the implications. You mentioned already that you are seeing, or some like, let's say, different incentives for corporate governments, for example, right? Or other effects, like just give us a little bit, like what does that mean? Okay, so now we're at this stage. It's obviously massive. So what does that mean? Because it might be like a structural shift in a way to that we have to look at some of these corporates differently.
Right. Okay, look, let's dial back 200 years or a bit more and go to Adam Smith. There used to be this guy called Adam Smith who wrote a book called The Wealth of Nations, and like 70% of all ideas that modern economics explores are kind of contained somewhere in that book. Anyways,
he's always coming up.
The baseline model of competition, or how competition is supposed to work and lead to the wealth of nations, goes something like this, right? So there's a baker on one side of the street, and there's another baker on the other side of the street. And these bakers have absolutely no interest in the well-being of society. What their interest is in becoming rich, all right? So every morning they wake up, check out what the other baker has done in terms of baking bread and what they price it at, and try to steal market share from each other, right? So the one baker says, well, we have the same bread. The other guy sells it for £2. I shall undercut the price and sell it for £1.50. Presumably that means all or most of the customers come to my shop. And I could just sell way more bread. But of course, the other baker does the same thing and wants to undercut him. And the result is that the bakers offer cheap and well-tasting bread to the population, not because they like the population and care about that, but just because their individual self-interest, as if by an invisible hand, right, leads them to compete and attempt to steal market share from each other, and hence leads to the wealth of nations. Okay, right? So the traditional way of thinking about a lack of competition goes like this. It says, well, these bakers at some point are going to realize that this is not a way of making a living to compete with each other like that. They are going to just meet over a few beers and cigars in the pub next door, and just decide that the price of bread henceforth shall be £4 instead of £1.50.
Right.
And that's called price fixing or collusion. And since a bit more than 100 years ago, tends to be a criminal offense, and they go to jail if they get found out. And that's about it. Okay. Well, but there's a more elegant way of undermining competition. It goes like this. The bakers say, hey, why don't I sell you 50% of the shares in my bakery? And I don't take money for it. I just take 50% of the shares of your bakery instead. And this way, you own 50% of your bakery and 50% of mine. I own 50% of my bakery and 50% of yours. And the effect of that is that we don't have to agree that the price of bread is the monopoly price, say $4 or £4 a loaf. But every day we would have incentives to undercut it, to steal market share from each other, but we took away the incentives to compete, right? Why is that? Because if I went to undercut your price, well, I would steal market share from your bakery, but I'm really stealing market share from my bakery as well, because I own 50% of it. So the only effect me attempting to steal market share would have is that market prices would be lower, and the value of my portfolio would be lower as well, okay? And you can see where this is going. Where this is going is that nothing here is confined to this being 2 bakeries and 2 shareholders. There could also be 8 bakeries, and the 8 bakers each hold 12.5% of the respective bakeries. They're fully diversified, so to speak, but that removes the incentives to compete, okay? So let me be very clear. The point here is not that the 8 bakers to collude in order to undermine competition. The whole point is that you don't need to collude anymore when you're fully diversified, because there are no incentives to compete in the first place that collusion would have to overcome. So the point is that diversification across competitors takes away the incentives to compete. And therefore, well, I mean, why would they compete if they don't have incentives to do so, right? The more modern equivalent here is that the big asset managers, for many reasons, including the one I just explained, simply don't have an incentive to push firms to compete super aggressively against each other, or reduce costs and, I don't know, start fights with the union, fire employees and whatnot. And when you hear the public statements by the BlackRocks of this world, they're full of, oh, we don't really do anything with portfolio firms. We have nothing to do with the firms firing their employees. Well, and also we don't get involved in competition. We would never talk to firms about competition. And the point is, yeah, that's the problem description. That is the problem description. In a capitalist system, the shareholder is supposed to talk to management about product market competition, namely to entice them, to push management to reduce costs, to fire the employees, to somehow produce the products at a cheaper price and steal market share from the rivals. And this very basic capitalist incentive basically gets lost when the firms get increasingly controlled by the asset managers. And I say control in the very specific sense of like sitting on these control rights, but not using them, or not using them to the effect of, pushing firms to compete super aggressively against each other, right? So you're still looking like you listen attentively. So I hope that's
no. I mean, so it's like pretty much like price, also like kind of price discovery. Therefore, because of this ownership, is probably like there's less incentives, and price discovery is working less well. So when you kind of bring this into the now, in terms of case studies that you have, or like actual data, like what's this, like how does the spider web of these of the ownership look like? And do we have any kind of particular case where it's like interesting, where we see, okay, so that's an interesting case study here, we might actually see that what we just hypothesizing might actually be really an issue?
Right. So the spoiler is, I didn't invent that. The guy who invented this theory or hypothesis is a guy called Julio Rothenberg,
okay,
who turns out got his PhD from an institution called Princeton in the early 80s, and then went on to become an MIT professor and was for several decades at Harvard Business School. So he's a guy who said, hey, this whole diversification thing, it sounds great, finance professors, but have you ever realized this is going to kill competition and therefore decrease welfare? Like, it's basically killing the whole point of capitalist systems. So the hypothesis is not new at all. My claim to fame is to have co-authored the first paper that arguably shows that there are situations in which indeed common ownership, that's how we call it, common ownership of competitors causes higher product prices. okay, and coming up with a whole bunch of examples of industries where that seems to be an issue as well. So let me give you a few examples, right? So before I started working on this, I just thought that the largest shareholder of Microsoft was obviously Bill Gates. I mean, look, everybody knows that, or so I thought. Spoiler, that's wrong. The largest shareholder of Microsoft is Vanguard, followed by BlackRock, okay? And I thought that the largest shareholder of Apple clearly must be Steve Jobs, or I guess Tim Cook. And that just turns out to be completely false as well. The largest shareholder of Apple and is Vanguard as well. All right. So that is just a matter of like the scale of the holdings. I mean, once you think about this for a second, you can realize that it can't possibly be true that the CEOs own a large fraction of these firms, right? I mean, look, let's call Apple a $1 trillion company. Holding 10% of that would be 100 billion. And look, Tim Cook is rich, but he's not 100 billion rich, right? So, so once you think about it, you realize that can't be right. But I'm just saying I was wrong before I started working on that. So, you know, all these examples of coming up with industries like airlines or banks or, I don't know, publicly traded waste management companies, this is basically the claim to fame. Now, I should at this point also explain that it's not just the indexers that cause common ownership of competitors. Like Warren Buffett is pretty big in that game, right? So he became the largest shareholder of 3 of the 6 largest banks in America during the financial crisis by generously providing capital for that. These days, he's in the news for a few years ago, having bought large stakes in the 5 largest Japanese trading houses. He was the largest shareholder of 3 of America's largest 6 airlines. So, you know, people call Warren Buffett a stock picker, but what he really does is pick industries and buy the largest stakes in like all the largest players. And it just turns out that, well, so that's one example. Another example, I just mentioned the US waste management industry. Turns out the largest shareholder of one of the publicly traded waste management companies is a investor called Cascade Investments. And you're like, what are you talking about? And the answer is, this is Bill Gates' family office. It's called Cascade Investments. Okay. It also holds close to 5% in the closest competitor. The Bill Gates Foundation owns another 5% in that competitor. So the point is, it's not just indexers that drive common ownership of industries. It's also a bunch of actively managed funds or conglomerates that just deliberately buy up stakes in competitors. And the combination of all of the above appears to have the effect of lessening competition in the sense of driving up product prices. And, you know, that's basically the claim to fame. Since then, there's an entire literature with hundreds of papers that have examined this up and down from one industry to the next, and public policy discussions all over the globe in how one should deal with that issue. Because, yeah, conceptually, right? So again, in practice, one could just go after Bill Gates' family office and Berkshire Hathaway and I don't know what as a start. But conceptually, the problem is that diversification just doesn't go together with competition, right? So that calls for some seriously deep thinking in what the optimal policy would be, and whether we want to allow financialization to continue the way we did so far.